What is Forex trading? Hi, this is Jason from SA Shares, and today we are going to be taking a look at an overview of Forex trading and what it's all about. Be sure to like, comment and subscribe if you enjoyed this video. Let's get into it. Firstly, Forex has been around since nations first started minting money. Each country has their own currency, which means to visit or do business in that country, there needs to be a way to exchange the currency that you have for the currency that you need. That is Forex. So what is Forex trading? Forex trading is when a Forex trader buys and sells currencies with the main aim of making a profit. Your profit or loss is the difference between the buy and sell rates of the currency pairs traded. Forex trading in the past was done solely over the telephone by professional investors. Today, there are a vast number of normal ordinary people investing for themselves from the comfort of their own homes. The advancement of technology has been a key factor behind the evolution of the trading market, making the market more accessible to more people. Everyone has a stable, high-speed internet connection nowadays, and this allows access to this world of trading. So how big exactly is the Forex market? It is a thriving market and values up to a staggering $6.6 trillion worth of currencies that are traded on average every single day. There are 16 independent Forex exchanges operating throughout the world and Johannesburg, and South Africa is the newest global Forex exchange market. These exchanges operate independently, but they all trade the same currencies, effectively dividing the Forex market into sequential, sometimes overlapping sessions. This means currency trading lasts all day and all night, 24 hours a day, 5 days a week. For example, when the trading day in the United States ends, the Forex market begins again fresh in the morning in Tokyo and Hong Kong. Most Forex traders will hone in on the popular trading periods known as the Forex 3-session strategy, focusing on Tokyo, London, and New York sessions. The Tokyo session, also called the Asian session. The Asian session is the world's third largest Forex trading hub, with 20% of all Forex trading taking place during this session, made up from trades in Hong Kong, Singapore, and Tokyo. The London session, also called the European session. The London session takes part in nearly 43% of all Forex trades in the world, making London the center of Forex trading in Europe, alongside Paris, Edinburgh, Geneva, Luxembourg, Frankfurt, Zurich, and Amsterdam. The New York session, also called the North American session. The New York session is the financial center of trading in the United States, with around 17% of all Forex transactions taking place there. Because 85% of all Forex trades involve the dollar, when great US economic data is announced, it can move the markets. So, what do Forex traders do? Currencies usually trade against each other as pairs, which are known as exchange rate pairs. For example, the US dollar and the euro. Forex traders look out for certain indicators, from global news and market sentiments to economic data and credit ratings, to determine whether a currency pair will go up or down. If you exchange US dollars for Japanese yen, for instance, the yen's worth appreciates over time. Then you can trade it back for US dollars and make a profit on the difference in value. If you are going to become a Forex trader individually, you would then be known as a retail Forex trader. So, what are the benefits of Forex trading? Well, first, it's the largest financial market. The Forex market is the largest financial market in the world, and it is not going to lose that title anytime in the near future. It is not hard to see why the Forex market is used as a parameter of global trade and economic activity. 4 to 5 trillion is traded daily on average. That's about $200 billion an hour, $3 billion a minute, and an incredible $50 million a second. Forex trading is now open to anyone. As discussed earlier, because of technology, Forex trading is open to anyone getting involved. This, coupled with the fact that getting started as a Forex trader does not require a lot of capital anymore, especially when compared to trading stocks or options, makes it a great way to start investing for yourself. Minimum deposits are normally extremely low, if not zero, to open an account with a broker of your choice. High volume and liquidity. Liquidity is the ability of an asset to be quickly converted into cash. In the world of Forex, the high liquidity means large amounts of money can be moved in and out of countries with generally small spreads. Nobody owns the market. Because of the previously mentioned large size of the Forex market and the number of traders, no single person or institution can control market prices for any extended period. Also, the Forex market is decentralized, and there are no middlemen. You trade directly with another participant in the market, and a retail Forex broker simply facilitates this connection. Essentially, the market is influenced directly by the economy itself, not one person or a company. It cannot be monopolized or manipulated or controlled. Trade, whether going up or going down. The Forex market has no restrictions on directional trading. This means that if you think a currency pair is going to increase in value, you can buy it or go long. And if you think it is going to decrease in value, you can sell it or go short. Because currencies trade in pairs, you are always actually buying one currency and selling the other, no matter whether you are going long or short. Unlike in the stock market, where you first borrow shares to sell short, in the Forex market, selling a currency you do not own is a remarkably simple process in which you just place a sell order. A 24-hour market. The Forex market never sleeps. Open 24 hours a day, 5 days a week. You can trade whenever you want to, not when a market opens and closes, as in the case in other markets. Since the Forex market is a global market, trading is open if there is a market open somewhere in the world. Trading opens when the first major market opens, which is in Sydney, Australia, at 5 p.m. Eastern Time in the US on Sunday, and trading closes for the week when the New York market closes at 5 p.m. on Friday, only because it is the last major market to close. No commissions on most Forex accounts. There are generally no trade commissions or incredibly low ones for large volume trades. Most brokers earn their revenues through the spread, or the difference between the bid and the asking price. There are also no clearing or exchange fees. Low transaction costs. As mentioned in the above point, the difference between the bid and ask price is the broker's spread, and this is the retail transaction cost. Highly capitalized brokers can offer extremely competitive spreads, thus minimizing your trading costs and maximizing your profits. The cost of a transaction is typically built into the price in the Forex market in the form of the spread. Spreads are usually less than 0.1% in the normal market conditions, and Forex brokers pocket the spread as the payment for facilitating the trade. Leverage. Forex brokers often allow traders to buy and sell in the market with higher amounts of capital than what is in their accounts. This is called leverage. You are in essence borrowing from your broker to trade in amounts greater than your actual deposited capital. This can be a massive advantage in trading Forex in comparison to other markets. If you were to trade at 100 to 1 leverage, just as an example, you can trade $100 for every $1 of capital in your account. Effectively, that would mean that you could do a trade of $100,000 using only $1,000 of capital in your account. It is important to know that leverage works both ways. It can work to your advantage or against you. Risk-free demo accounts. More often than not, you can make use of a free Forex demo account to practice Forex trading as you learn and develop your skills as a Forex trader risk-free. The amount of virtual money given is dependent on the broker, as is the environment that you will be trading in. Many brokers offer real-time trades and scenarios that are exactly the same as the real trading environment, just simulated data. Understanding the risks. It may sound very appealing to trade in Forex because of the potential high gains, but before jumping in, you need to understand the risks. Almost any kind of trading has its own risks. It can also result in big profits, which is one of the reasons so many people enjoy trading Forex. It is a risky, complex, but also exhilarating task, when you are winning, of course. Forex is not something you should do without arming yourself with all the knowledge, tips, and expert advice that you can get. Unregulated brokers. The interbank market is highly regulated. However, Forex instruments, the type of financial medium used such as swap, option, spot, or forward, are not standardized, and in some places around the world, Forex trading is completely unregulated. Let's explain. The interbank market is made up of banks trading with one another around the world. These banks have established internal processes to help keep them as safe as possible, and they have regulations to protect each bank that is involved in the process. Since the marketplace is created by each of the individual banks providing offers and bids for a specific currency, the market pricing is based off supply and demand. There are usually large trading flows happening at any given time in the system. The upshot is, it is difficult for rogue traders to influence the price of a currency, and this system helps to create transparency in the market for investors who have access to interbank dealings. However, in the Forex market, small retail traders have a greater risk because they may deal with small and unregulated or semi-regulated brokers or dealers who do not have the same transparency as required by regulations. Lack of knowledge. One of the other risks is one that you are 100% responsible for: not sufficiently educating yourself. Never jump blindly into Forex trading because a mate says he makes tons of money off of it. You must know what is the driving movement in currencies, the economic and political landscape in those economies, as well as global events, to name a few. A successful Forex trader knows what drives currency values and has access to the best trading platforms and forecasting tools, backed up with solid economic models. It is vitally important to do your homework and choose the right Forex broker and trading platform for you to become a successful individual trader. Before we end this video, we are going to list some of the pros and cons of trading Forex. Let's get started with the pros. Accessibility, leverage, potential for fast returns, easy short selling, liquidity, technical strategy, less potential for insider price manipulation, fewer fees and commissions, simple tax rules, automation, and 24 hours a day, 5 days a week trading. Under the cons of trading Forex, we have volatility. Small traders may face some disadvantages. Lighter regulatory protection, fewer residual returns. Large losses when unsure about capital exposure. A lot of competition as an individual trader. Just because the market is open 24 hours a day doesn't mean you should trade all day. No centralized exchange, and high-risk factors. And that's it from me. Hopefully this overview of what is Forex trading is helpful to you. To open an account with SA Shares now, click the link in the description. Thanks for watching, and as always, good luck trading.